The lights flicker and the bill arrives. A number so shocking it feels like a declaration of war on your bank account. In a distant conflict zone, a pipeline is severed or a threat is issued. And halfway across the world, in a glass-walled corporate headquarters, an executive looks at a screen and sees a graph spiking into the stratosphere. This is not a coincidence. It is a business model. While nations bleed and households freeze, a specific set of corporations perform the coldest alchemy of all, turning artillery shells and geopolitical fear into record-shattering profit. How? Because for the modern energy conglomerate, war isn't a disruption. It's a strategic opportunity. If you've ever felt like a hostage to your own utility bill, you need to understand the game being played. Tell me right now, where are you watching from and what time is it? To see the hidden math behind the headlines, hit like, share this, and subscribe to decode this profit engine. We must follow the money through 3 distinct, ruthless channels. This isn't about simple supply and demand. It's about mastering volatility, exploiting arbitrage, and weaponizing necessity. The players are the super majors, the public-facing giants like Exxon and Shell. The trading houses, the shadowy private giants like Vitol and Trafigura. And the specialist extractors, the companies that drill and mine in the world's most dangerous places. Together, they form an unofficial global consortium that profits not from creating energy, but from managing the chaos around it. First, the most visible, the supermajors and the crisis premium. Companies like ExxonMobil, Chevron, Shell, and BP are structured like financial instruments as much as oil companies. When war erupts, their public strategy is one of grave concern and operational caution. Their financial reality is different. They benefit from what markets call the geopolitical risk premium, an automatic price surge baked into every barrel due to fear of disruption. But their real profit lever is their trading desks. These are internal hedge funds, operating with insider knowledge of their own global production, shipping, and refinery schedules. As prices gyrate wildly, these desks engage in contango plays. They buy physical oil cheaply, store it in their vast tank farms, and simultaneously sell futures contracts at much higher prices, locking in massive, risk-free profits. The 2022 energy shock saw Shell's trading division alone make over $6 billion in a single quarter, skewering losses elsewhere. Their public face is the gas station. Their private engine is the casino. They run on the price of the fuel they sell you. But the supermajors are constrained by reputation and shareholders. Not so for the second group, the trading houses, the ghosts in the machine. Based in the secretive cantons of Switzerland and the freewheeling hubs of Dubai and Singapore, firms like Vitol, Glencore, Gunvor, and Trafigura are the undisputed masters of war's chaos. They own no gas stations. You will never see their logo. But they move more oil than most countries produce. Their profit model is arbitrage on an epic scale, buying energy where it's cheap and trapped, and selling it where it's desperate and expensive. When sanctions hit Russian oil, these traders didn't retreat. They built a shadow fleet of old tankers, created new payment channels outside the dollar, and became the architects of the dark voyage. They buy Russian Urals, crude at a $30 per barrel discount, blend it, repaper it, and sell it onward, pocketing the difference. They perform the same magic with LNG, liquefied natural gas, chartering ships to become floating billion-dollar arbitrageurs between continents. For them, war simplifies the world into logistical puzzles and sanction-shaped loopholes, each with a lucrative solution. In 2022, Vitol reported revenues exceeding $500 billion, larger than the GDP of Norway or Thailand. Their profits are the pure extractive fee on global panic. The third channel is the most brutal and direct, the specialist extractors profiting from the front lines. These are the companies that operate where others fear to tread. in the oil fields of Iraq and Kurdistan, the gas basins of Mozambique amidst insurgencies, and critically, in offshore and fracking regions suddenly deemed strategic due to war. Their advantage is risk tolerance. They secure contracts with weakened governments or breakaway regions at vastly favorable terms, betting that the conflict will secure, not destroy, their assets. War sweeps away environmental regulations, labor protections, and public scrutiny. A company like DNO in Kurdistan or Total Energies in Mozambique operates on a calculus where the security premium they charge for operating in a war zone is pure profit. But the poster child here is the U.S. fracking industry. The Ukraine war transformed it overnight from a debt-laden struggler into a geopolitical savior. As Europe banned Russian gas, U.S. LNG exports became a weapon of policy. Fracking companies, once pleading for subsidies, were suddenly signing 20-year supply deals at prices linked to the hyperinflated European market. The war didn't just raise their prices, it guaranteed their demand for decades, bailing out an entire industry and minting new. Billionaires in Texas and Pennsylvania. This tripartite system operates in a feedback loop. The trading houses create price volatility, which the supermajors' trading desks exploit. The resulting high prices justify the risky investments of the specialist extractors in conflict zones, and the ongoing supply from those zones feeds the trading houses' networks. War is the catalyst that makes this loop spin faster and more profitably. But to see the sheer brazen scale of this profit, we must examine the quarterly report card of conflicts, the actual numbers posted in the immediate aftermath of crisis, where the abstract becomes obscene. In the calm, sanitized language of an earnings call, the truth emerges. Phrases like favorable macro environment, strong margin capture, and unprecedented market volatility translate to a single, brutal fact. War is good for business. The quarterly financial reports released in the shadow of conflict are not mere statements. They are victory bulletins from a parallel war, one measured in billions of profit per month. This is where the abstract engine of profit becomes a concrete, staggering reality that rewires our world. Let's examine the war profit scoreboard. In the aftermath of the 2022 energy crisis, the numbers defied belief. ExxonMobil posted a $56 billion annual profit, not only a company record, but a historic high for the entire Western oil industry. Shell announced $40 billion, Chevron $36 billion, and BP $28 billion. To put this in perspective, Exxon's profit was greater than the GDP of over 120 nations, including Lebanon, Bolivia, and Iceland. This wasn't just a good year, this was a geopolitical jackpot. But the real kings, the private trading houses, operate in opacity. Vitol, privately held, doesn't detail profits, but analysts estimate its 2022 net income soared to around $15 billion. That's over $40 million in profit per day. Trafigura reported a record $7.4 billion. These are profits extracted not from increased production or brilliant innovation, but from the violent repricing of a necessity, facing public outrage. Governments in Europe and the UK proposed a seemingly logical fix, the windfall tax. The concept was simple: claim a portion of these unearned war profits to fund household relief. What happened next was a masterclass in corporate financial engineering, exposing the second layer of the profit model, the regulatory arbitrage game. The energy giants did not simply pay. They executed a three-step maneuver. The leveraged threat. They immediately announced cuts to capital expenditure, the very investments in green energy and new production that good politicians demanded. The message was clear: tax us, and we'll jeopardize your energy, security, and climate goals. The accounting shield. They massively increased share buybacks and dividends. In 2022 to 2023, The 5 Western supermajors returned over $110 billion to shareholders. Why? Because windfall taxes are typically levied on profits, not on distributions to shareholders. By funneling cash directly to investors, including their own executives, via stock-based compensation, they drained the pool of taxable profit. The jurisdictional dodge: multinationals shifted reported profits to lower tax jurisdictions through transfer pricing on trading operations, intellectual property royalties, and debt financing. The profit from a barrel of oil sold in the UK could be legally recorded in a Singaporean subsidiary. The result? The windfall taxes collected were a fraction of the headline profits, and the company's market valuations and shareholder payouts continued to soar. The tax was a political theater, while the profit machine continued unabated. But the most profound and terrifying profit is being booked not for this quarter, but for the next decade. The war has triggered the golden age of the long-term contract. Panicked nations, desperate to avoid future blackmail, are now signing 20-year LNG supply deals at prices linked to the hyperinflated European benchmark TTF, not the cheaper American benchmark Henry Hub. Companies like Shinnery Energy in the US and Qatar Energy are the ultimate beneficiaries. They are locking in astronomical margins for a generation. For example, a German utility signing a deal with Qatar today is essentially agreeing to pay a permanent war premium for decades, regardless of whether the conflict continues. The war has structurally rewired the pricing architecture of global energy, and the corporations own the new grid. This leads to the final and most cynical profit center: the green pivot premium. The same supermajors posting record fossil fuel profits are now loudly championing their investments in hydrogen, carbon capture, and renewables. The war, by spiking fossil prices, has given them the cash gusher to fund this transition on their own terms. They use fossil profits to buy up renewable startups, securing dominant positions in the next energy system. They lobby for technology-neutral policies that favor their massive, centralized projects like blue hydrogen from natural gas over truly disruptive, decentralized green energy. They are using the profits from perpetuating one crisis to control the solution to the next. The ultimate arbitrage, selling us the poison, and, at a premium, the antidote. So, who truly profits? The shareholder in New York receiving a ballooning dividend. The private partner in a Geneva-based commodity house. The LNG trader in Houston locking in a 20-year deal. The fracking executive whose bankrupt company was saved by a European panic. And who pays? The European family choosing between heating and eating. The Bangladeshi factory worker laid off because the diesel generator is too expensive to run. The Nigerian farmer whose fertilizer cost has tripled. The global taxpayer funding energy subsidies to quell social unrest, while the corporations that created the price spike pay a minimal, performative fee. The system is perfectly designed. It privatizes the windfalls of geopolitical violence and socializes the costs. The energy company's balance sheet is insulated from the very chaos that fills it. We have reached the apex of a perverse logic where the stability of our daily lives is a direct threat to their bottom line. And our collective vulnerability is their most valued asset. The final question is this: when a sector's profitability is so exquisitely tuned to global conflict, can it ever be a force for peace? Or have we created a set of private sovereign powers whose fundamental interest is in maintaining a state of managed, profitable emergency? Let me know in the comments. If this pulled back the curtain on your utility bill, hit like, share this critical breakdown, and subscribe.